So guys, open your notes, put the heading CA Final Financial Reporting. We are starting with Ind AS 16. What is this? Property, plant. What is this? Property, plant and equipment. Property, plant and equipment. Okay. So basically, what is property, plant and equipment? It is nothing but a tangible asset. Property, plant and equipment is nothing but a tangible asset. Okay, so you call it land and buildings, you call it plant and machinery, you call it furniture, fixtures. So if you look at the nomenclature, the title, there are three words. One is property, one is plant, one is equipment. You might have studied in this schedule 3 financial statements. In that also you might have used property, plant and equipment. This is international language which we started using from 2017. Before 2017, in India, we never used the word property, plant and equipment. We used to use the word fixed assets. That is the reason your accounting standard 10 originally was fixed assets. Then it has become AS 10 property, plant and equipment. Okay, so this includes all the tangible assets. This includes all the tangible assets. So we are going to learn everything in the accounting for tangible assets. Okay, now the Ind AS, that is property, plant and equipment accounting standard in the new generation is far above your old accounting standard. For example, I'll give you one small example so that you understand. So I want your participation also. My class is not going to be a one-way communication. You need to extensively participate. Now in this live class, I will ask some questions. In the chat box, you need to answer. In the chat box, you need to answer. Okay, develop the habit of responding more. If your answer is incorrect, doesn't matter. But participation is more important. Participation is more important. So look here. X Limited purchased a machine costing rupees 10 crores from Y Limited. What is this? X Limited purchased a machine costing rupees 10 crores from Y Limited. The payment terms are, the payment is to be made. The payment is to be made. The payment is to be made at the end of third year from the date of purchase. How the machine is to be recognized in the books of X Limited. This is the question. Very important question from exam point of view also. A teaser, a tidbit for you to think and to develop, this level of thinking. Point number 1. Point number 2, from exam point of view also, this is an important question. X Limited purchased a machine costing rupees 10 crores from Y Limited. The payment is to be made at the end of third year from the date of purchase. How the machine is to be recognized in books of X Limited. Okay, so I'm waiting for your answer. Can you tell me what is the journal entry? What is the amount with which the journal entry is to be passed in the books of X Limited? Okay, can you tell me the answer? I'm waiting for your answer in the chat box. So very good. Majority of you have given the answer that the journal entry is property, plant and equipment. In brackets you can write machine if you want. Debit 10 to Y Limited, credit 10. This is the journal entry everybody said. This is absolutely right as per AS 10. But welcome to CA Final. This is not a correct journal entry when you are a CA Final student. Ting, 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 ting. Pavan sir, what makes the difference? What makes the difference? See, remember one basic rule. No asset can be recognized in the books of account with a value which is more than its fair value or recoverable value. For example, if I go to the same Y Limited, I asked him, boss, how much this machine is? He said 10 crores. Then I asked, what is the payment term? What is the payment term? He said 3 years. If I say I have enough cash, I will pay you with a single check today. Today I will give you check. But I am not ready to pay 10 crores. 10 crores is too much for me. So what is the cash down price? So you are giving deferred credit to me. What is this? Deferred credit extended to 3 years, which is beyond normal credit period. Normally, who will give 3 years of credit period to you? Normal credit period can be 15 days, 30 days, 45 days. So this is extended credit period. I said, I do not want this extended credit period. If I pay you cash today, at what price you will give this machine to me? Then Y Limited said, 9 crores. Give 9 crore rupees, take this. Then logically, substance over form, logically, X Limited is paying 9 crore rupees towards procurement of that property, plant and equipment. For acquiring that property, plant and equipment, they are paying 9 crores. For this deferred period of 3 years is there, no? Deferred period of 3 years. For this deferred period of 3 years, they are paying 1 crore rupees as interest. Okay, now the question is that 1 crore rupees of interest, whatever I am paying, can I capitalize it? The answer is no. Why? Because the asset is put to use. You might ask, Pavan sir, borrowing cost is there, accounting standard 16 or Ind AS 23. According to borrowing cost, interest paid on machine can be added to the machine. Beta, yes, but not after the asset is put to use, no. Is this a qualifying asset which takes substantial period of time for its production or construction? No. This is a ready to use asset. So when it is a ready to use asset, how can you capitalize interest? So this 10 crore rupees should be broken into two parts. The fair value of the machine and the interest component. Fair value of the machine is to be capitalized. It will go to balance sheet. That interest component is there, no? We need to do something called unwinding. What is this? Unwinding. Amortization also we call. Unwinding of interest or amortization of interest. Okay. Then you will have to take that to your income statement. Interest paid. Pavan sir, how do we calculate that, interest? Simple. 9 crores is present value. 10 crores is future value. After 3 years, because I am paying it is 10 crores. Today, if I pay 9 crores. So, this 9 crores is present value. 10 crores is future value. What is the rate of interest which equates 9 crores of present value with the 10 crores of future value? This is in your financial management IRR. In financial reporting, in accounting at CA final level, or when you are reading IFRS, we call it amortization rate. Nothing but interest rate, discount rate. Amortization rate. So you will use some amortization rate. Say for example, you got 4.35%. So you will use this IRR and you will calculate how this 9 crores is becoming 10 crores. In 3 years. This is year 1, this is year 2, this is year 3. Then 9 crores is becoming 10 crores. No? So you will calculate here X rupees, here Y rupees, here Z rupees. X plus Y plus Z put together will be 1 crore. So this X rupees you will take to P&L in first year. Y rupees you will take to P&L in second year. Z rupees you will take to P&L in third year. You understand? That is how we have to record. Now, property, plant and equipment will not be recorded at 10 crores. All of you said, Pavan sir, machinery account debit to Y Limited account 10 crores. No, machinery account debit to Y Limited 9 crores only. So what is the accounting principle here? The accounting principle here is an item of property, plant and equipment is an item of property, plant and equipment is recognized in the books of account on the date of acquisition at its fair value or the cash down price, equivalent cash down price, if there is any deferred credit period beyond normal credit period. If you are extending normal credit period to me, Pavan, purchase this machine, pay me within 1 month. Okay, normal transaction. But if you say, Pavan, you can buy machine from me, you can pay money after 3 years. That means I have to understand you are not only selling the machine, you are financing my machine also. So you expect consideration towards the sale of machine and consideration for giving that 3 years of finance. You understand? This principle, whatever I told you one principle now, no? Deferred credit terms. This is applicable for property, plant and equipment. This is applicable for intangible assets. And this is applicable for inventory also. For inventory also this is applicable. You understand? These are the basic changes from normal accounting standards to Ind AS. Substance over form. Previously, calculation of fair values, present value, future value, these kind of things were not there in Indian accounting. In Indian accounting, we never used present value, future value. In accounting, in finance, we use. For the first time, because of this Ind AS, we started using all these concepts in India. Okay, so shall we see one problem on this? I do not want to overburden you with too much of theory. I will explain all the theoretical concepts also. At the same time, we'll do some problems also so that it will become some warm-up exercise for you and you will not be bored. You will not be bored. So, we'll do one problem and then we go back. Okay. This is the problem. Deferred payment credit. Okay. This is going to be our problem number 1 in this batch. The first problem we are seeing. So before that, let us try to read the principle and understand what it is. So read the para. The cost, what is the situation? Payment deferred beyond normal credit terms. Payment deferred beyond normal credit terms. The cost of an item of property, plant and equipment is the cash price equivalent. What is this? It is cash price equivalent. On the date of recognition, at the recognition date, whatever the cash price equivalent is, that should be capitalized as an asset. If payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the period. Interest over the period of credit. However, if the asset is a qualifying asset, if the interest can be capitalized as per your old accounting standard 16, now we call it Ind AS 23, BC, borrowing cost. So as per your Ind AS 23, if it can be capitalized, that is a different issue that we will not see here. Here, what do we see? Normal credit period given, normal journal entry. Beyond normal credit period is given. Then we calculate cash price equivalent. This is the principle. Based on this principle, they have given illustration 1, first question. Okay. So shall we see this question? On 1st April 2011, an item of property is offered for sale at 10 million with payment terms being 3 equal installments of 33,33,333 over a 2-year period. Payments are made on 1st April 2011. That means today you paid one installment. Today you bought 1/4/2011, you bought the asset. 1/4/2011 itself you paid 33,333. Okay. And second installment is paid on 31st March 2012. Third installment is paid on 31st March 2013. Implicit rate of interest. Have you heard this anywhere? Do you remember using this implicit rate of interest? in your CA intermediate in advanced accounting standard 19. You remember leases. In the leases, when you are doing, accounting for finance lease in the books of lessee, then you used one rate. What is that rate? Implicit rate of interest. What is implicit rate of interest as per accounting standard 19, which is nothing but the IRR from lessor perspective. Same here, it is also IRR. Implicit rate of interest is nothing but IRR. So 5.36% per annum. Show how the property will be recorded in accordance with Ind AS 16. Can you take 1 minute of time? I will not give you more time. Can you take 1 minute of time? Calculate the cash equivalent price of the machine and tell me. Calculate the cash equivalent price of the machine and tell me. Can you do the working? Please do it fast. So I want answer from you. Not a difficult thing, okay? Simple thing. If it is difficult thing, I will not ask you. I am still waiting for your answer. Sir, 1 minute is not over, sir. Please sit happily, quietly, sir. Okay. You calculate and tell me. Take your calculator. I got my answer. You are still not ready with the answer. So anyone who got 95 lakhs approx as answer? Gaurav is saying 95 lakhs. Very good, Gaurav. Correct answer. Anyone else who got 95 lakhs? Anyone who got 95 lakhs? Only one student. Come on here. Okay. Write down. Problem number 1. Under that, working note 1. Problem number 1. Under that, working note 1. Working note 1. Calculation of working note 1. Calculation of cash price equivalent of the machine. Cash price equivalent of the machine. Okay, so year 0, 1, 2. Why 0? 0 means today. Year 0 means today. Year 1 means at the end of first year. Okay, at the beginning you call it 0. At the end you call it 1. So what is the installment paid? Amount paid 33,33,333. Then 33,33,333. Then 33,33,334. Total 10 crores. Total 10 crores. 10 crores or 1 crore? $10 million means 1 crore. Okay, so it is not 10 crores, it is 1 crore. Okay, now discount factors at 5.36%. First one is 1 only, because at the beginning, no, today only you are paying. Why will you calculate present value? Now, second year, how to calculate? 1 divided by 1.0536. 1 divided by How am I calculating 1 divided by 1.0536? Because 5.36%, no? You should not write 1.536. It will become 53%. You understand? See, if you are taking 8% in financial management, how you might have done? 1 divided by 1.08, that is 8%. If you take 1 divided by 1.8, it will become 80%. You understand? So, what is the discount factor you got? 0.949, 0.949. Can someone tell me what is the discount factor for the next year? I need your participation. You need to calculate at the end of second year, what will be the present value? Just take your calculator, calculate and tell me. Okay, correct answer. Someone is saying 0.901 in the chat box. Correct answer. Gokul, correct answer. Nirmal, correct answer. Gaurav, correct answer. Very good. Okay, now multiply. Present value. Discounted amounts, which is nothing but present value. Okay, so 33 lakh 33,333. Next one, 333 into 0.949. That comes to 31 lakh 63,333. 31 lakh 63,333. You understand? Next, 334 into 0.901. That comes to 30 lakhs 3,334. 30 lakhs 03,334. Plus, add all the three. It is exactly coming to 94 lakhs 99,999.9. So can I say 95 lakhs? So machine should be recognized with 95 lakh rupees of value. You understand? The machine should be recognized with 95 lakh rupees of value. This is working note. So is working note 1 clear? Is working note 1 clear? Write down. Journal entries in the books of. What is the name of company? Company name is not given. So we'll write just journal entries. Journal entries. Write the proforma, particulars, debit rupees, credit rupees. Okay. Day 1, 1/4/2011. What is the journal entry? Purchase journal entry you need to write. What is the purchase journal entry? Property, plant and equipment account debit 95 lakhs. 2. On the day when you purchased the asset itself, you made one payment, no? How much? To cash account. How much you paid? 33 lakhs 33,333. 33 lakhs 33,333 to Y Limited account. This balance is the loan. 61 lakhs 66,667. 61 lakhs 66,667. Okay. That's it. This is the journal entry. Now tell me guys, how many of you understand this journal entry? Do you understand this journal entry? Hello, any doubts in this? If you have any doubt, ask me. Otherwise, I'll move further and there are 2-3 other entries to be passed that I'll show you. So in the chat box, let me know, shall I proceed? Hello, your participation please. Give me a hint whether you understand. Okay, no doubts. Yes, we can move on. Very good. Okay, now tell me what is the next step. So on 31/3/2012, that means at the end of the year, you are making a payment of 33,33,333, no? So can I say Y limited account debit? Y limited is my, is it Y limited? No, there is no X limited, Y limited. It is our assumption. So we'll write accounts payable. So in my example, it is X limited, Y limited. So here we write accounts payable. Supplier. Accounts payable is 61, 66, 667. So at the end of the year, when I'm making payment, can I write accounts payable? Accounts payable debit 33,33,333 to bank account 33,33,333. So can I write this journal entry? The answer is no. This is wrong journal entry. Why 33,33,333 you are paying. So this part is correct. But the whole is not towards accounts payable for supply of machine. Some finance component is also there, no? Some finance component is also there. So you need to recognize that finance component also. How will we do that? Leave space for another one journal entry, some 5-6 lines you leave, and then prepare working note 2. Leave some place and write down working note 2. Statement showing calculation of finance cost, or you can write down interest expense. Statement showing calculation of finance cost or interest expense. How will we prepare year? Opening balance, we'll take opening balance. Interest at a rate of 5.36%. Interest at a rate of 5.36%. Installment amount. Okay, so principal amount, and then we write closing balance. Okay, year 1, or you can write 1/4/2011. Opening balance is 95 lakhs. Correct? I don't need to pay any interest now because today I have paid an first installment of 33,333. So this full amount is towards principal amount only. 33,333. So what is the closing balance? 95 lakhs minus 33,333. So 61 lakhs 66,667. So for 1/4/2012, closing balance of previous year is my opening balance here, 61 lakhs 66,667. On that, calculate 5.36% interest. So it is 3,30,533. 3,30,533. So how much I am paying? 33,33,333 installment I am paying now. In that installment, what is interest amount? 330,533. 33,33,333. So many threes are there. Be careful. Minus 3,30,533. So the balance is towards principal amount repayment. How much that is? 30,02,800. You understand? So this installment is divided into two parts. Part 1 is this. Part 2 is this. So in the journal entry, 33,33,333 blue color is there, no? That will come in the credit to bank. 33,33,333. In the debit, 3,30,533 will go to income statement because it is interest expense. It is interest expense, and that remaining 30 lakhs 2,800 is there, no? This will reduce your liability. Now calculate the closing balance. Opening balance is 61, 66, 667. Opening balance is 61, 66, 667. Okay. Minus how much of it? Principal amount you have paid 30 lakhs 0 to 800. That comes to 31 lakh 63,867. So next year 1/4/2013 opening balance will be 31. Opening balance will be 31. Sorry for the interruption, my power cable was not on, so the system got shut down with low battery. I'm sorry for that. So we'll continue. Okay. So at the beginning of third year, the opening balance due is whatever is the closing balance. What is the closing balance of previous year? 31, 63, 867. Is it right? 31, 63, 867. On that, calculate 5.36%. Calculate 5.36%. 31, 63, 867 into. That comes to 1,69,583. 1,69,583. Then the balance is 29 lakhs 94. 29 lakhs 94 284. Is it right? No. Wait. Hello. Hold on. Installment is 33. Out of this, you have paid 169,583 towards interest, minus 169,583 towards interest. So what is principal amount paid? 31,63,750. So the closing balance is 0. Now the difference between this and this is there, no? This is rounding of difference. This is rounding of difference. So one better way of doing this is, even in ICA study material also they have done the same thing and they have shown the difference. So there is some 100 rupees odd difference is there. But the best thing what we can do is, installment, you know this, outstanding, you know this. So write interest as the balancing figure. Then that 0 will come and there will be no rounding of difference also. So what we can do is, we can correct this amount. How? So total 333 I am paying. Out of that 31,63,867 is the principal amount. So write 169,466 here. Happy? Now you will pass these journal entries above. That's all. Okay. Now go back to your journal entries and write down second journal entry. Interest expense debit. Interest expense account. Working note 2. Debit. How much is interest expense as per our working note? 330, 533. 330, 533. Now accounts payable will not be this amount. Accounts payable, how much? 30, 0 to 800. Now look at the journal entry. Interest expense account debit 3,30,533. Accounts payable 30 lakhs 2,800. To bank 33, 333. You understand? Then the third journal entry, 31, 3/2013. Same entry will come. Interest expense account debit. Accounts payable account debit to bank. To bank how much? 33, 33, 333 or 4, whatever. Okay, interest expense kitna hai? 169,466. 169,467 it will be. 467. 1 rupee we increase, 33, 33, 334. So 1 rupee will be increased. So the balance is accounts payable. How much it is? 3163,867. 3163,837. Okay, these are the set of journal entries. 3 journal entries. Simple. So now tell me, we completed solving this problem. The concept is when there is a deferred credit period beyond normal credit period. When there is a deferred credit period beyond normal credit period, then the cash equivalent price only can be recognized as an asset. The balance should be treated as interest expense. So every year need not say second year that interest expense 3,30,533 is there. No, that will be charged to your P&L. You will take that to P&L. In the P&L, you will write profit and loss account debit to interest expense. Profit and loss account debit to interest expense. That's all. You understand? So these are the 3 journal entries. Okay. Any doubts in this?